the International ESG Summit 2022. This event is being brought to you by Bazanet, which has an aptly coined tagline, mainstreaming sustainability, and in partnership with the CF Institute. Mainstreaming is exactly what the organizers are trying to achieve in the next 48 hours. And not just mainstreaming sustainability, but even accelerating and advancing it to the next level, which is regeneration. The excitement in each of you is palpable, as the favor of the season, ESG, is creating a ripple effect in everything that it touches. And it touches every organization and enterprise in one way or the other. The host of the conference, Buzz On Air, intends to bring some of the core issues of the ESG that need an in-depth understanding to the fore and move beyond what is already being known and discussed in such forums. So the summit goes beyond the ABCs of ESG, beyond the aspirations and buzzwords and compliances, which are normally the case. The summit spread over 2 days will be very light on your schedule. It just goes on for 3 hours on each day and has a lineup of 5 intense sessions, 3 on this day, on day 1, and 2 more on day 2 tomorrow. I encourage each of you to attend all the sessions for a holistic understanding of the subject, which will also make you eligible to receive an attractive participation certificate and some exciting redeemable BOE credits. You will know what they are when you apply for them. But remember, these are only for those who attend all the 5 sessions. Okay, make it a point that you attend all the 5 of them. Each session goes on for about, say, 40-45 minutes, and we'll have some 10 to 15 minutes of the time for the audience question answer sessions. So all the audience who attends are muted by default when they enter, but I encourage each of you to keep your questions coming through the session, through the sessions by typing them in the chat box or the Q&A box and make it as interactive as possible. The entire conference is streamed live on Bazanet's YouTube channel, and you can follow it right away and also share it with your friends and colleagues on your social media platforms. The session is also being video recorded and will be made available on BOE's portal by early next week for everyone to watch it on demand. Please do remember that this virtual session or summit is just the part 1 of the 2-part conference, where part 2 is scheduled sometime in September this year. We'll keep you updated on the exact dates and the session details well in advance. And we hope to keep all of you engaged through these 5 months. But right now, it's time to invite Gayatri Chauhan, the founder and CEO of Bazanet, for her opening keynote. Over to you, Gayatri ji.
Thank you, Gautam ji. Thanks a lot. Namaste. Hello, good morning, good afternoon, and good evening to all the people who have joined us from all the different parts of the world. Very, very excited to welcome you all. And this is the International ESG Summit 2022. And we are kicking this, whole summit now. We are starting it now, but this intent is to continue it for next 5 months. So this is not going to end in these 2 days, and that is the beauty of this format. So we are going to continue the dialogue because we demand action, and we are demanding action from governments, from businesses, from investor communities, and from the communities at large. So idea is not just to have yet another conference on ESG and get done with it after 2 days. We want this to stay, we want this to stick around, and we want this to have very tangible impact. And for that to happen, we are sure that we have got the best of experts, best of the minds and brains working in the field of ESG from all over the world. And this is a truly international summit in the sense that we have more than 30 countries represented in the speaker panel itself. And from audiences, if I count, we will be, touching almost 190 countries. So that is very exciting. And we will be having sessions spread over 5 different panels. And the first panel will be actually headed and anchored by Mr. Paul Smith, who has been in this space for a very long time and has some very tangible contribution in actually furthering the ESG movement. So I'm very excited personally because the day 2 of this summit is going to move beyond sustainability towards regeneration. So while day 1 focuses on funds, investments, and governance as topics, but day 2 will be focused on taking a step beyond sustainability towards regeneration. And we are trying to see how ESG is contributing towards sustainable food systems. And food systems are such an integrated and important topic that it connects with almost every sector. And this is the time that we have to make that linkage very evident and felt the importance and make the importance being felt in the investor community as it goes. The three reasons why we think that this is very high time to do this conference and also to engage this dialogue. The first and foremost is that this is the time to move beyond ABCs. And when I say moving beyond ABCs, it is figuratively and literally both. So A stands for aspirations, B stands for buzzwords, and C stands for compliances. Many organizations are still stuck at the aspiration level. They want to actually do something about it, but probably have not enough clue or not enough traction or knowledge to go about it. And that is where the expertise comes in place. Second is about buzzwords. Many people are still confused with a lot of jargons that are used in the ESG space, and we have to somewhere move beyond that. And the third is compliances. For many organizations, and we get these requests on a regular basis, since Buzz on Earth, just to give a small introduction, that we are existing here to help organizations and businesses transform their aspirations into commitments and commitments into action. So that is where we come into picture. And when we receive these kind of queries that can you help us become ESG compliant? So that is where we see that compliance should not be the driving force alone. There has to be something more than that. So that is the first reason of doing this conference, that we got to move beyond ABCs. The second reason is this: ESG is not just a buzzword, it is pretty much an opportunity. And this is the sole savior for us, for our existence on this planet, because climate change is not a threat of the future. It is pretty much an immediate threat, and we have to work together towards that. And the third reason is this, that we have to somewhere understand that ESG is not going to go off. It is not a trend. It is not something which is trending now and will be gone by 2025. It is here to stay, and it is pretty much business as usual. And this is going to, this is as good as, we have to breathe with our nose, with our nostrils. So it is as fundamental as it goes. So we have to understand the importance of it, and it is here to stay. And it is very important for all the stakeholders to understand and implement that going forward. With that, I'll just welcome you all once again, and welcome our next speaker, Mr. Paul Smith. Paul, very warm welcome to you. And I'll just hand over the panel to you. And very warm welcome to all the attendees once again. Thank you so much for joining us.
Gertrude, thank you. Thank you for that very warm welcome and for that very generous introduction. And good morning, good afternoon, good evening. That's one of the challenges of Zoom conferences is that we have a truly global audience. So I apologize if this is an unfortunate time of the day for you, but hopefully you're all up and lively, in that we have a great panel here for you today. We have about an hour. I'm going to just open with a few comments and then really hopefully hand it over to the panel to take it on from there. And obviously any questions, please fire away on the chat line, and we'll try and get to as many of them as possible. As Gayatri said, my name's Paul Smith. I'm a founding partner along with my second partner called Kubra Kudelmeyer, who is based in Istanbul, of something called Sustain Finance, www.sustainfinance.org if you're interested. We talk, we blog, we write articles, we hold events around the intersection really of finance and sustainability. So this panel that we've got today, which is very much geared towards fund management companies and how fund management companies can assist in the sustainability conversation, is very much in our wheelhouse. So I'd like to just start by trying to set the scene briefly. Funds and fund management. The point of finance, and I think we sometimes forget this, the point of finance is actually to serve societies, to serve the communities in which we live. And I think often over the last 30 or 40 years, that very obvious comment has got a little bit forgotten. So much of finance activity is intra-bank or intra-professional counterparty. And less of it appears to actually serve the end client. And the end client is just another word for saying the societies in which we all live. And I think if there is a criticism that I would level at finance, it's that we haven't done enough. We need to up our game, really, in trying to make sure that we reconnect finance with that overall sense of purpose of serving the communities in which we live. And I think if we can align society's expectations of us with our own investment processes, then surely that's the best way that I know of maximizing profits, basically. And I think that's an important comment, because so often the criticisms leveled at ESG or sustainability investing is that profitability is not there. And I think, obviously, I hope we'll answer that question as we go through this panel. But I think really it's because there is a non-alignment of expectation in the world today, and we need to do better to make sure that everybody is on the same page and facing in the right way. So I think finance has a duty to up its game there. However, finance doesn't operate in a vacuum. We are part of an ecosystem, a circular system, in fact, that involves governments, regulators, society, which is just another word for our clients, and ourselves as industry professionals. And that circular system should both lead and follow each other, if you like. But at times, the fund management community should take a lead. At times, government should take a lead. At times, society should take a lead. And we should all do our best to make sure that we're following the leads that are given. It's not one nor the other. And if I have a criticism of regulators, it would be that I think over the last 20 years, they've taken too much of a back seat in this regard. That they've been lazy, really, in the way that they have sought to offload their responsibilities for sustainability to finance. And what I mean by that is that, financial professionals are very logical people. They will do what is in their clients and their own best interests. And if regulation, taxation regulation, accounting regulation is constructed to properly incentivize finance and to penalize it for poor actions, then finance will follow and do what is logically in its best interests for it to do. Because ultimately what we're trying to do as financial professionals is to make a return for our clients. But as I say, too often taxation regimes, anti-pollution regimes, for instance, accounting regimes are not supportive of the sustainability event debate. And that's where really regulators and governments need to step up to the plate more. Finally, clients do too. Fund managers, again, very rational people, they'll do what their clients demand. And I don't think that piece of it, although that's definitely improving, but I don't think that piece of the equation has fully come into operation yet. We need everybody in society to demand more of us, to demand that we allocate their resources in a way that they would like. And if that direction is towards sustainability, then I can promise you finance will deliver the goods as far as that is concerned in terms of products and services. So it is a circular system. Each person has to take their lead. Each participant has to take their lead. And others have to listen and follow that lead. But if we get that right, then I have no doubt that we can mobilize the world's resources in a fashion that is supportive to this conversation. And I think that's important to say, because finance has made great strides in the last 20 years. For those of us who were around 20 years ago and attended ESG seminars, it was very much a fringe event at the time. You were sort of laughed at, really, in some ways. You were a bit of a sort of a loony, tree-hugging, lefty sort of socialist person, not someone that you would traditionally believe to be within finance. And I certainly, in my case, I attended really just because I wanted to be educated, really. It wasn't that I was necessarily passionate about ESG at the time. I just thought it was a trend, a bit like cryptocurrency today, if you like, that I ought to know more about. And over the years, I became much more obsessed about it. But finance has come an awfully long way. I mean, today, over $1 trillion, according to Morningstar, are deployed in strategies that have an ESG context. And that will almost certainly treble between now and 2040, given the growth rates that we've seen over the last decade. But if we get this circular system right, if we can get the flywheel turning properly, Morningstar estimates that 3 or 4 trillion by 2045 could be as much as $70 trillion, a significant number, and very much the sort of number that most activists believe is required in terms of the investment that needs to go into sustainability over the next 20 or 30 years. So the positive message is really that the money is there, but the system isn't quite working in a way that will enable those assets to be deployed correctly to where we need them to be. And that's the piece that needs to be fixed. But it's not a depressing message at all. It's a very positive message that finance will follow if society and regulators provide the right sort of leadership as well. So that's important. Obviously, I don't want to underplay the risks, the challenges that are out there. We have a lot of skeptics to overcome. That's for sure. Greenwashing is very definitely a problem where asset managers claim to be doing one thing in sustainability, but are doing something else. So that's an important issue. Data. We often hear about data being poor at the corporate level. And education is important for industry, for participants such as ourselves, for regulators, and for society. So major challenges, but the solutions are appearing, and I think that's important to say as well. I think the most exciting development for me of the last 20 years is that the ESG conversation has moved away from risk management and compliance and very positively towards investment opportunity and investment return. And I'm sure we'll hear a lot more from that from our panelists. And most obviously, that's in clean energy, in agriculture, in financial inclusion, perhaps. Those are the obvious areas where people are focused for investment returns. But more and more, there's a broad spectrum of investment opportunity that's appearing. So I think that's important to say. Greenwashing is being addressed by regulation. SEBI in India is doing an awful lot in terms of their disclosure regimes and their corporate governance regimes. The EU has a new taxonomy out and divides funds into various shades of green as well to help consumers. And organizations like one of our sponsors today, CFA Institute, are also stepping up to the plate. CFA has just produced the ESG disclosure standards, which is a major piece of work that I hope Christoph will talk to us a little bit about, because he's been involved with that on this panel. And those disclosure standards will operate to help institutional investors and others really describe, monitor, and report on their strategies much more effectively in the sustainability space than we've done in the past. Data, endless initiatives, as we all know, out there to improve corporate data standards, and that's happening all the time, and perhaps we'll hear a little bit from Michael and others on that as we go through this panel. But what I would say is I would urge investment managers, particularly professionals, to look at this as actually quite a positive short-term problem as far as they're concerned. Poor data is an opportunity for investment managers to not only supply that data, but to actually use the poverty of data to their own advantage, to try to make sure that they understand the data better than their competitors, and to try and make sure that they can use that data poverty in a way that supports their own strategies. So don't get negative about poor data. Use it profitably as far as your own strategy is concerned. And finally, education. I think there are lots of initiatives in that space. Again, I'd turn back to my old friends at CFA Institute and warmly recommend anyone who's listening in on this call to go to their website and look at the CFA certificate in ESG investing, which is a major initiative and something that I know is very warmly thought about in the industry at present. So I think all of those challenges are being addressed to a very large extent. Finally, I would say that one of the other things that's most exciting out there at the moment is that 20 years ago, I think we thought of this sustainability challenge as being something that some supranational body would resolve in some magical way for us, a sort of a UN of the ESG world that would wave a magic wand and all of these challenges would go away. I think the exciting development has been that really we've understood as we've gone through the last 20 years that ESG means different things to different people in different locations. And that's why I think it's fabulous that we've got someone from America, someone from the EU, someone from Britain, someone from India to talk to us about this on this panel. Because the most exciting thing is that solutions are being driven, I think, bottom up much more than top down. Appropriate solutions that are tailor-made to the individual circumstances that apply in any one country. And I think that's tremendously important. We're all headed in the right direction, more or less. I agree that sometimes it doesn't appear that way, but we are all headed in the right direction, and we're finding solutions that are applicable to the individual circumstances in which we live. So I really think that we're at a takeoff point. I think where fund managers and the investment world can really move beyond the current ESG conversation, beyond risk management and compliance, and give life to those buzzwords that Gayatri talked about earlier on, and really to deliver the aspiration that we all hope that we will have a world that is better suited to the clients of today and to the clients of tomorrow. So I'm going to end it out there and start bringing in our excellent panelists. I'm going to fire a question at each one of them to start off with, and I'd like them to begin by telling us a little bit about themselves and their businesses and how they fit into this conversation. And I wanted to come first to Michael Underhill, who's talking to us today from the US. Michael is, by anybody's standards, a veteran of data analysis, Michael, data scientist originally, a veteran of ESG investing, has his own business in this world in hard assets. But he's talking to us from America, which arguably is the most cynical, the most hard-bitten region of the world in terms of this conversation. So Michael, kick us off by sort of talking us through what it's been like to have been a pioneer in this in the US over the last 20 years, and particularly coming at this conversation from your formation years, really, as a data guru. So over to you, Michael.
Well, thank you for the kind introduction, Paul. Ladies and gentlemen, good morning, good afternoon, good evening. I must say, we look at the world today, 2022, and I look at the series of challenges and the opportunities that are laid before us. And big data has helped us solve a lot of problems over the years, over the decades, if you will, right? I've been in this investment industry for 30 years. My undergraduate degree, I spent time as a quantitative economist back in the early 90s, spending time in statistical econometrics and multivariate regression analysis. Graduating from college, I sent out 200 resumes. I got 198 rejection letters. I think the most pointed rejection letter was, with a quantitative economics degree, you're suited to go work for the government or paint bridges. This was the prevailing job market in 1992 in the United States. So I was effectively a college graduate with a useless degree in data and econometrics, according to Wall Street standards. And I ended up getting a construction job after college because I couldn't find any employment, right? Interesting challenge that was laid before me. I looked at some of my fundamental background. I grew up a fifth of 5 children. My father was a working class steel worker in Pittsburgh, Pennsylvania. We grew up in an industrial town where the water was dirty, the land was dirty. There were some issues with some of the environmental policies of some of the local companies, and I always had conversations with my father about why these companies would want to do things like discharge pollution chemicals into the river, why there'd be a chemical plant that would discharge some kind of emissions into the air that would cause the snow to turn green overnight. And think about some of these issues growing up, where the snow would be green and the water would be so hazardous that fish couldn't exist in a body of water in Western Pennsylvania. Something that was just very mystifying to a young boy. But so my pursuit of economics and quantitative economics was to try and solve some of these fundamental societal issues, and to understand and better inform me of what goes on in the world with societal development. So think water, food, energy, some of the bedrock, the essential services of the economy and societal development. And I think, Paul, to your series of questions there, starting out in finance and making my way into the investment world of Wall Street, Lehman Brothers, and some of these other places where I've worked over the last 30 years in both fixed income and equities, applying a quantitative or data intensive approach to measuring factors so we can build models that actually inform us and help us make better decisions, make more informed choices to manage for better outcomes. And I think that's the bedrock of sustainability and ESG investing, right? One cannot manage what one cannot measure. So data is only good as the data scientist that's inputting the data, as well as the team that's interpreting the data. And so I look at the last 30 years in this business, and I think we've progressed tremendously, but I think it's a marathon. It's not a sprint. And I think we still have many, many kilometers to go. And I think we have many, many challenges that are laid before us, but those challenges are not insurmountable. I think we can solve them with big data. I think we can solve them with measurements and to your point about various projects. Over the years, working with the CFA Institute and the UNPRI, and most recently in the last year with the ESG Convergence Project globally in private markets, I've been fortunate in the sense that I've worked in both public and private markets, traditional, long only, and alternatives. So I've seen the continuum of liquidity products. I've seen the continuum of public and private markets, ESG, impact investing, sustainability, and being able to build data sets in the 90s for socially responsible investing, for infrastructure debt, working through the 2000s with some of the formative years that morphed from SRI, socially responsible investing, to really that formation of the UNPRI as one of the first signatories, working with the UNPRI on their working committees. We had several working committees that we set up. I was working in infrastructure. That was my focus, public and private markets. In 2011, being asked to chair the infrastructure work stream, create a very complex and robust data set that was able to measure, account for things like hydrocarbons, communications infrastructure, enhancement of aging infrastructure, renewable energy impact, as well as other things that touched upon infrastructure like agriculture and some of the water scarcity issues and water infrastructure on a global level. And I think, I won't take all the air out of the room, for lack of a better phrase. I'll try and sum this up in the next 30 seconds. If you were to look at your original question around the US and why ESG has been such a challenge to adopt in the US, being born and raised in the US, I could say that's pretty simple. Very few people in the US travel. Very few people actually have access to international travel and access to an understanding of the challenges of frontier markets, emerging markets. And so the US is the land of milk and honey, plentiful agriculture, plentiful energy as a natural resource, plentiful clean water. I grew up in a small area in which I had a appreciation for it because that was a statistical anomaly. The United States has food security, water security, energy security, more than 3,000 years of natural gas in terms of energy security. So the average US citizen takes for granted their position of not having to worry about on a daily basis clean water. And when you look at water being the largest source of death in emerging markets, unclean water, or things like energy security, where unfortunately we're seeing the situation playing out in the Ukraine and with Russia. It's impacting not only energy, it's impacting agriculture and the food supply chain system and the global food system, which we'll talk about a little later. So I think the U.S. as a U.S. citizen, I can tell you we're in a favorable position. In parentheses, we're quite spoiled because we've been born into a region, geography that's had a favorable position from an energy and water and food security perspective. I think people are now starting to re-examine that. And to your earlier point about ESG assets, moving 20-fold according to Morningstar, I think that's something that is part of the tectonic shift for investors, retail investors, institutional investors, saying, how can I invest, do well and do good, generate a unit of return, but a unit of social return, and invest my capital so I can make an impact and invest for the next generation of sustainable companies and help with societal development. So again, I pulled all the air out of the room. I took a little more time than I should have, but let me just stop there.
Michael, thank you. You didn't. You're spot on timing wise. Very, very impressive. I think that was a wonderful analysis. I particularly liked your comment on data being a marathon and not a sprint. And I think when we spoke before, you said something to me that really resonated with me. I just wanted to push you on it a little bit, that data is always being improved. And I think that's a comment that I think is very important for people, because they tend to, or people seem to talk about it in a very binary way. You know, when is data going to be perfect? And I guess for someone like you, data is never perfect. It's always improving.
Well, that's you hit the nail right on the head, Paul. And I think I was also fortunate. I grew up in a family where we were all three sport athletes: football, rugby, track and field. My father used to coach, and I look at both playing football, but also internationally playing rugby in college, Super League rugby. If you want to be a stronger athlete, you have to spend time in the gym. And the more time you spend in the gym, the stronger you will be. The more time that you spend running, training, the faster you'll be, the better performing athlete you will be. As a data scientist, the more time I spend on the data, the more time I look at the factors and the modeling and the methodology behind how we're measuring climate, how we're measuring water, how we're measuring sustainable agriculture, we can narrow the field, become better performing athletes, become better data scientists, and have more precise measurements. But it all starts out as a very messy, amorphous mass of just data that we need to form and shape and form our own opinions and hypotheses and be intellectually flexible. Not unlike an athlete, you have to be flexible, you have to be fast, you have to be strong, but you continually get better as an athlete. You continually get better as a data scientist the more that you apply it, and the more that you execute these mental gymnastics and really work your way towards some kind of a potential solution or a series of solutions. And admittedly, taking in data analysis and being a data scientist, taking a multipolar approach in a bipolar world.
Right. Great. That's really, really fabulous. Thank you for that. Very helpful. I want to turn to BD next, an old friend from India. I think it's nice to juxtapose India with America. I mean, Michael was very honest and upfront about the way that sometimes this debate struggles a little bit in the US. BD, tell us about Abacus, your public markets, but tell us really, sort of try and pick up on some of the things that Michael talked about in terms of what ESG, what sustainability means in India from a public market perspective, as well, maybe from a private market perspective too. What's the sort of universe of investable opportunities like there? And, you know, how maybe you're going about integrating ESG into your own investment processes in Abacus. Far away.
Thank you, Paul, and good evening, everyone. People who are dialing across the world on this panel. Paul, to your point, I mean, a brief about Abacus. So Abacus is a long-only equity manager, started in 2018 in India. We are close to like $1.5 billion of assets, and trying to obviously move more offshore, but focusing on governance as a key factor over other things. Now, you asked about the state of public markets in India. Data providers like MSCI or other ESG provider, I mean, they hardly publish close to like top 100 companies rating. India has like the most number of companies listed around in the world, almost like 4,000. So the ESG coverage is less than like 2%. Even if you look at the investable universe of like 2,000 odd companies, that number still will be hardly 5% of that. So on one side you have that problem. The other side is because of the vastness of the market. 50% of the market doesn't even have an analyst coverage rating on maybe Bloomberg, right? So you have a long sort of base in terms of a pyramid where you don't have coverage at all. And then you have the, pinnacle of a pyramid where you have like most covered. I mean, India is one of the most over-covered equity markets in the world in terms of number of analysts covering, a company. There are like more than 50 companies where more than 50 analysts are covering, from a sell side perspective. So do we really have alpha in the top sort of, 100 companies or maybe the large cap? Probably no. So you have to obviously move down, the needle and go from there. So that's one. The other part is, large part of businesses in India are like more traditional, more utility, oil and gas, more manufacturing and power. So you hardly have pure play ESG players like clean tech or EV or even climate tech, stocks which you can build in your portfolio. So globally, yes, ESG has been very popular, and in India, it's still at a nascent stage. I mean, as of maybe last year, there were like close to like 10 funds in mutual fund space, which were dedicated ESG fund out of like a total of 1,000, with total assets of close to like $1.5 billion, which is less than 1% of the total mutual fund AUM on the equity side. What has been changing is a push from regulation. So the local regulator SEBI has made mandatory for the top 1,000 listed companies to issue what they call as business responsibility and sustainability reports, which are in line with international ESG frameworks like Global Reporting Initiative. And what they do is they try and lay down some quantifiable metrics, which allows for easy measurement and comparability across companies, sectors, or time periods, right? So from suddenly where you had only data available for 100 companies, in FY 22-23, 1,000 odd Indian companies listed from market cap will issue these reports. And suddenly you have a plethora of data which analysts would be scrambling to understand what it means or what it covers. So on one side you have very little coverage, and we are on that cusp where immediately we are going to sort of get maybe 50-60% of the market at least bombarded with that data. On the other side, I mean, the other way which regulator thought about mandating some sort of ESG discipline in investors is mandating the stewardship code. So it was already mandated for insurance companies, and it was made mandated for the mutual funds and the alternative investment funds where we belong about 2 years ago. And apart from other things which you can control, maybe you can actively take participation in the company's policies. But if you can't, one of the tools which was given was that you have to mandatorily vote on all the resolutions, and you have to disclose it to investors on why you have voted or why you have voted against otherwise, right? So that's what the regulator thought. But the problem is, the top 10 mutual funds, mutual fund houses in India cover almost 60-70% of the market, and six to seven of them are like large financial houses, and they have multiple businesses. So how can you say no vote to a corporate who has given you maybe $20 billion in liquid money, or who is like a great investment banking client of yours, or who is your debt client? So there is some conflict which is out there, so that's on the regulation side. Fundamentally, India obviously has been, we don't have much oil and gas. So, the only thing we have is coal. So majority of the power, which is almost like 70-75% of the power, is coal-based power, right? Even though the Prime Minister obviously has recently announced in COP26 that India will get to net zero by 2070. And I think they'll cut 40% of the emission by 2040. But what is interesting to note is that the incremental capacity which is coming in terms of gigawatts is coming on wind or solar or some of these names, right? So emission standards are changing for auto companies, which whether it is BS6 or BS7 norms. There are subsidies on electronic vehicles. Almost like 20 cities in India are getting a metro construction, which obviously, apart from decongesting the traffic, also should help pollution a little bit. Solar parks, wind projects are coming left, right, and center everywhere. It's a phenomenon of cost. So, we being, capital-starved country, wherever cost obviously goes down, it helps us, sustain from that perspective. So, large insurance companies are maybe focusing on clean mandates. Almost all sovereign wealth funds or global sort of players who invest in India have an ESG mandate, and you possibly cannot get their allocation if you are not following ESG. So what does it mean for investment managers like us? So do we get real good data on E and S? Probably no. So we focus on G, which is obviously the governance part. And in hindsight, from a moral science perspective, if your governance standards are high and if you take care of all the stakeholders, it's highly unlikely that you will not think about environment or people who are, with your business. So it's kind of an indirect correlation, but, may not work out full-fledgedly. So that's one way we try and do it. The other way is we obviously, our portfolio doesn't have any exposures for auto or oil and gas or tobacco. So you try and sort of do some sort of negative list, which obviously, brings down your non-ESG, exposure to that. But beyond that, it's evolving. I mean, I'm just waiting for next year's the same time when most of the companies will be releasing their ESG data, and it'll be fun to find out which companies are compliant when they say they have already compliant and which are not. So these are interesting times.
That was really excellent and very, very thought-provoking. I'm going to put you on the spot just because I like to do such a thing. Is there any chance of India meeting those COP targets that you talked about? I know you're not a government minister and you're not responsible for policy, but what's your view?
As a responsible citizen, we will abide by what the Prime Minister has said. We will make all our efforts to go there. But look at it this way. If more and more, government is trying to do certain things which it can. So it has obviously control on infrastructure spending. Almost every city in India is sort of, we need infrastructure. So what they're trying to do is they're trying to sort of encourage this private investments by boosting their own spending, right? By providing these subsidies, tax holidays, other things. Beyond a point in time, government has to start first, and then obviously industries have to sort of take over. But can we really move away from, let's say, a coal-based energy system? Possibly no. Maybe not in a short frame of time, but maybe over 10, 20 years, from that perspective. So if you work hard and we work collectively, I think we can achieve, some of those targets. But it has to be like a consistent government priority, which if there is a stable government, that can be achieved. Plus, obviously, the debt side. If you look at the capital equation, if majority of the capital which is coming in India is obviously foreign capital, whether be it FDI or FII, and if they start demanding some of these standards, everybody will be forced to adapt. So it's a bit of chicken and egg, a little bit of force, a little bit of push, a little bit of awareness. I think we should be there.
Thank you, and what a perfect cue up for our next speaker, Fabrizio, who I'm going to turn to next. The Climate Bond Initiative. Fabrizio, tell us a little bit about that. It's nice to get a short break in this panel from fund managers. You're a very different animal. So tell us about CBI, the various initiatives, and really talk to us a bit about that point that Bidi was making. How can the fixed income markets help make up this shortfall in investments? We've heard a lot from our equity participants so far, but you're obviously a fixed income guru through and through. So talk to us a little bit about that, what the tools are available, how the fixed income markets are going to ride to the rescue, and what CBI is doing to support all of that. Fabrizio is talking to us from London. He's on mute at the moment, but hopefully he'll remain.
Yeah, sorry. Yeah, it's typical, right? You're on mute. Well, yeah, perfect, Bidi. Well, the good news is that one tool that investors are using, especially in the green bond market, is taxonomies. And the good news for India is that India is developing its taxonomy. We, as like the Climate Bonds Initiative, we are an NGO, not for profit. We are missionaries. Our mission is really to channel private capital to climate solutions. And what about this bond market? Wow, 120 trillion, right? So there is scale. We need scale. And I like the Mike's analogy about the marathon, the sprint. Let me push it a bit more. That's our role as NGOs, push investors. And well, let's sprint during the marathon, because we need to do that. We need to reduce emissions by 50% by 2030. That's crucial. So we really, and by the way, emissions are still going up. So how are we going to go there? Well, it's very easy. Well, very easy. Well, we know the numbers. So McKinsey is telling us. So we need 9 trillion investments per year to transition to a low carbon economy. Today, globally, around 6 trillion of capex is spent, of which 3 is actually in high emission activity. So we need to redirect those 3 trillion, and we need an additional 3 trillion. So where are we going to get that? Well, the bond market has potential to do that. But even so, if you take the green bond market, well, it's about 2 trillion. Great, but we need much more. We need scale. And so from a Climate Bonds Initiative, we think through these, and we've been launched in 2012. And we had already at that point, back of our mind, and this idea of the taxonomy. We hear, data and definition. Well, taxonomy is just what good looks like, right? What is green and what is not green? Now, it can be easy and can be difficult. It's easy in the sense that we are really keen to to make it science-based. So it's the science telling us what is green. Gas, well, it's not green. We know scientists are telling us we need to stop investing in infrastructure for gas. So that's what the science is saying. So we are basing our taxonomy on that. And so we launched the first taxonomy in 2012. And it's basically used by the green bond market as a basis for what is credible and not, what is science-based and green and what is not. And that idea of taxonomy obviously has taken off since then, of course. So we work, so at Climate Bonds, we certify actually green bonds. Investors are using us, let's say, to look at the credible green bonds or the less credible green bonds, what we call aligned with those not aligned. But at the same time, we work with policymakers around the world to define their taxonomies. And our role is really to try to first make it science-based. Again, that sounds easy, but actually it's not that easy, because when you have business interests coming into the equation, that's an issue. And so we really focus on that science basis. And then the second thing that we want to do is we know India needs capital, especially emerging market needs capital. We want those taxonomies to be aligned. And that's another thing that we are working very hard with governments around the world. So we started with obviously our own taxonomy, but with the EU platform for sustainable finance, which is actually at the forefront, and for us is a standard. Everyone looks to the EU taxonomy today and compare. So today we work with about 10 different kind of policymakers around the world about their own taxonomies. And we think it's a very, very important piece to get right, to get those investors and investments to flow into what is needed. And last bit, I would say, well, we saw that the green bond market is a success, and so why not, scaling up that market even more so.
Thank you, Fabrizio. Are there other tools other than green bonds in the fixed income world? Are there anything else that we should know about? I mean, green bonds, I think people have heard of and may not know what they are, but we're all sort of semi-familiar with the concept. Any other fixed income tools out there that you're involved with?
Yeah, very, very good question. So the evolution of the green bond market has been obviously the social bond, blue bonds, COVID bonds, pandemic bonds. But what's the most, let's say, the most significant innovation is the sustainability linked bond market, which is growing really fast. I think there's about 300 billion issued. And it's an interesting one because there's a big take up there, especially from the hard to abate sectors. The sectors that couldn't really participate in that green bond market because they're perceived as brown and not green, which is a bit of a pity, because of course we know that we need those brown companies to turn green. So we need to help them. Now, the question about those sustainability linked bonds, which are really interesting and different types of instruments, I'm not going to go into the details of it, but the gist is that, are they credible? So companies are setting themselves targets, greenhouse gases targets mostly. But in our analysis, many of those actually are not really credible. We are doing something, but we don't have to do something. We need to do the thing. And again, there we as Climate Bonds are working on standards and definitions to try to kind of push the envelope to the extent that it's actually meaningful and credible. But it's a fantastic market. The instrument itself is fantastic. It's just more about how ambitious are we with those.
Great, thank you. I need to do some research on those. Thank you very much. And that segues into, last but not least, Christoph, you've been very patient waiting there. Christoph's based in close to Frankfurt am Main, anyway, in Germany. We're delighted to have you, Christoph. He runs he'll tell you about it himself, but he runs a very, what I would call, hard form ESG business, fixed income as well as equities, I think, Christoph. And I'd love for you to sort of tie some of these things together as the man who bridges wealth, the fixed income and the private equity. You've really set yourself quite a task in terms of what you do for a living. And I'd love to know how successful you feel you're being, what are the impediments to your success, what you would ideally like to see in the future. So I'll hand it over to you.
Thank you very much for having me, and it's absolutely great pleasure to be here. It's always learning a lot and connecting, so that's thank you very much for the organization. So indeed, I'm a portfolio manager for 25 years, and I got involved with ESG around, I would say, 2006-07. Became head of ESG credit at DWS. It's a big German asset manager. But I thought it is important really to have an ambition to really optimize all the dimensions of sustainability. So we talked about ESG, and some, including us, are seeing it as a risk, but also it is certainly an opportunity, as you say, and that comes with a sustainable impact that we create and measure impact and report about it. And we strongly believe that companies doing well, having sustainable products and services, should also do better financially over the longer term. We certainly have specific areas like climate risk, which is outstanding at this, and the consequences. Also linkages to social factors are very clear, and we want to serve our stakeholders, and that's beyond our investors. And we, with the supply chains, we clearly understand that we need to look far ahead, need to understand complexities, need to look through, and with that we want to create funds which are really sustainable. So we measure that and report about it on a monthly basis. So we want to be transparent. And that is why we have so many different data providers, because we are very strict in our filtering process. So we have a long list of exclusion criteria, so coming from churches and other organizations, and we work with positive lists so that we have not an unintended error. So it's like guidelines that is helping us on an operational side. But then really about ESG, different factors, certainly you mentioned GRI, there's also SASB helping us to find the most material factors for every sector. And then the big topic is now SDG impact measurement. How do you do it? And our funds are Article 9. And in Europe, that is kind of classified, some say simply dark green. And here we need to prove it. And it's not only measuring the positive impact, but you also have the term principal adverse impact. So we need to show that we do not do negative consequences. And that is early days. And there we certainly have data gaps, and especially smaller companies or emerging markets, which is sometimes a shame, because we know that they have fantastic products and services, and that is why we want the data, because we want to invest. Because if we have the gaps, we face the risks that we cannot report to our regulator that we are indeed sustainable. So this is why bridging the gap is so extremely important for us. So we aim to have our funds Paris aligned. And to give you one practical comparison, the German index, equity index, would cause a warming of 4 degrees. And if you look at forecasts like Chief Risk Officer Forum have done a fantastic, very transparent publication, you don't want to live in a world with 4 degrees warming. Starvation, mass migration, because in uninhabitable zones, we have to avoid that. And that is why we work so hard, and not only selecting companies, but also engagement. And that is where we spend a lot of time talking to companies, because we also believe it's a process. So we say it doesn't make sense only to invest in telecoms because they have low CO2 emissions. I think our job is really spending time, knowledge, and a network to help others to do the transition. Because we will need steel in India, for sure, also in the next 40, 50 years. So that is why it's about establishing renewable energy, investing, also maybe better processes and so on. So there's so much to do, and it's kind of giving us opportunity and hopefully helping many stakeholders.
Christoph, thank you. That's fascinating. I often think with you are such a prophet for this world that I wonder whether when you've run all these data tests and all these exclusions, I mean, is there anything left for you to invest in, basically? I mean, it's I often am concerned on that level.
That is absolutely correct. It's a very fair point, because we are so extreme that indeed we start with a universe of 20,000 and we come up with a universe of 200. Wow. And that is what no asset manager would do, because the tracking error is high. As you know, to being a portfolio manager for 25 years and have serviced big institutional clients in the past, I know about diversification. So that is why, certainly from a risk management perspective, we need to diversify across sectors, regions, maturities, ratings, and so on. And it's still possible. It's hard, yeah. So it's no piece of cake. But the positive thing again, companies are getting better. So our universe, which is eligible for us as a boutique sustainable asset manager, is growing. And in addition, with our engagement, hopefully we are supportive and helping some to become better investable overall. So that is why we have a long-term forward-looking approach. But indeed, sometimes it's tough. Like last year, renewable energy suffered. This year, it helped. But otherwise, certainly it's also kind of insights and political issues about risk management, where we sometimes get an edge. And maybe we are faster with hedging, reducing risk, and this is sometimes also helpful from a performance perspective. But you're right, our universe is smaller because we are very, very strict.
Thank you, and thank you for everything you do. I mean, it's an amazing business you run.
Thank you.
We've got about 15 minutes left. I'm going to try and get more of an opportunity feel and a client feel from this last round of questions. So, Michael, I'll come to you first and just ask you a little bit about what are you excited about from an investment opportunity perspective, and how easy has it been for you to generate client enthusiasm in the US and anywhere else in the world that you're getting clients from at the moment?
Well, thank you, Paul, and to the panelists, thank you. That was a learning experience for me as well. This is fantastic. I look at the challenges, I look at the opportunities. Our focus is on infrastructure, agriculture, real assets in both public and private markets. And I look out at the future of energy transition, some of the things that are going on with geopolitical risk, conflict in the EU and globally. And when you look at the stage that's being set for renewables, when you look at renewables, nuclear and hydro are projected to become the largest energy generators between 2030 and 2040. Roughly, there's about $22.5 trillion that must be invested in renewable infrastructure by 2050. And you look at Christoph keenly pointed that the Paris Agreement set into motion a treaty on climate change with a goal to limit warming. And for every degree we sacrifice, there are massive consequences. But with those challenges, therein lies the opportunity of which to invest in renewables. And I look at it as a quantitative economist and financial investor. How do we measure? How do we allocate capital to areas in renewables that make sense? And I look at renewables, solar and wind, in various geographies, countries globally. We've seen tremendous opportunity, tremendous returns historically, and think they will be there in the future because there's actually been a scarcity of capital allocated to solar and wind and other forms of renewables. And as a data scientist, the more I research hydrogen, we've invested in two publicly traded companies that have allocated over $3 billion worth of development in hydrogen. And I think hydrogen as the next transition from fossil fuels to clean energy is the future. And I think, we've talked to various energy economists and other financial investors about hydrogen and bridging the gap in terms of renewables. We're quite bullish on hydrogen. We've made investments that have actually made money in the last 2 years. We'll allocate capital to publicly traded companies in hydrogen, as well as we invest in private markets infrastructure in the renewable space as well. So we have a platform that invests in both public and private infrastructure, where we're allocating capital to areas where there's a scarcity of capital. And if you look at just from a financial perspective, wherever there's a scarcity of capital, those investors that invest in that space are handsomely rewarded by returns, 1, 3, 5, 10 years. So we see that opportunity set. I look at what's going on with the digital economy, and to Christoph's earlier point about telecom, carbon footprint, some of the things that are going on with data centers and cell phone towers, both in public and private markets. So it's the decarbonization theme. That's the one big theme that we're focused on, public and private markets infrastructure. The digitization theme and digital transformation. So that's the second theme. The third is enhancement of aging infrastructure, right? And when you look at OECD estimates for both emerging, or call it non-OECD and OECD markets, there's trillions of dollars of capital that needs to be allocated to enhancement of infrastructure. And BD touched upon this as well. When you look at coal and being able to move from coal to potentially first generation coal to third generation solar in India, how is that going to be done with government financing, with private capital? We think that solutions will have to come from multiple sources. Government has fiscal deficit issues. You've seen it in Australia, you've seen it in the UK. Private capital will step in with public-private partnerships and developers and provide that public capital in the public equity and fixed income markets to provide critical financing for that infrastructure. In private markets, you've seen pension funds. BD touched upon this with sovereign wealth funds. You're seeing that capital that's starting to come in through private funds and private allocations and joint ventures to solve the private capital solution to both OECD and non-OECD infrastructure. And last but not least, I'll touch upon when you look at agriculture, some of the agricultural infrastructure and agribusiness, the business of feeding the world, has been a challenge for hundreds of years. And I think technology solves a lot of that. But I look at the 3 pillars of agricultural transition. You've got food technology, you've got precision agriculture, and you've got agricultural sustainability. And when I look at food technology, we're looking at plant-based proteins. So think about alternative proteins in a world in which water is scarce. The amount of water intensity that goes into animal protein production, it's not going to solve the problem of feeding the world when we have roughly 9.5 billion people that are going to be on this blue marble by 2050. We have to increase our protein output by 75%. It's going to be through plant-based proteins. So food technology, animal feed and nutrition, and some of the other things that we're looking at in sustainable aquaculture. We've actually made investments in public markets as well as private markets. Precision agriculture, so think drone technology, indoor farming, vertical farming, and some of the data collection and data analysis for precision agriculture to enhance crop yields, to do more with less, because sustainability is really about doing more with less. And last but not least, when we look at ag, and I'll wrap this up, but the agricultural sustainability, we're looking at seed genetics and other types of sustainable food and solutions in the packaging space. There are companies out there like Corteva that have vitamin A enhanced seed, where they're able to deliver rice to emerging markets where the largest cause of blindness is vitamin A deficiency. They can deliver a genetically modified seed that's vitamin A enhanced and solves that conundrum, as well as that seed is drought resistant, as well as it's rot resistant, and that helps generate food, sustainable food, on a global level. So I'll stop there. Again, I've taken all the air out of the room. I'll allow some other time for the panelists. Thank you.
Thank you. Well, I'll come to BD next, and obviously plant-based protein is a huge issue in India, and one that is very well supported by society there. But BD, I really wanted to ask you about the client side in India. Are you feeling client pressure as far as ESG is concerned from institutions or from private capital? What's happening as far as the client side is concerned?
So in terms of sort of client side, one thing you have to understand is that governance has always been a big focus in all emerging markets wherever disclosure standards were poor or accounting sort of practices were not fair. So governance as part of overall ESG framework was always in focus, and that coupled with maybe, what happened in, early 2000 in maybe energy companies in US or IT companies in India, later during global financial crisis, fueled that, that desire or that need to sort of focus more on governance. So governance as an overall part has always been focused on. Of late, you see a lot of investors focusing more on, gender diversity, sort of, the water consumption which each businesses would have, to the extent the data is available. So, I'll give you a hypothetical example. One of the oil majors had a big, oil leak in, US, and I think the total penalty, which was, I think eventually came up to that oil company, was about $20 billion. A state-owned company in India had a similar leak in, Bombay High, and I don't think that the penalty numbers has yet come out even after 10 years. So large part of these things are still on the state-owned side where things need to be done. So from a client perspective, everybody is sort of, focused on governance. How much of data is available on environment and social, we don't know. I mean, India still is like 1/10 of the total emissions on carbon in last maybe 250 years versus Europe, or 1/5 versus US. But obviously they've been growing fast from that perspective. The good part is India is whatever mistakes or whatever sort of, we are sort of 10, 20 years behind the Western world in terms of certain places. So instead of sort of going through the same journey, we can directly jump on to the solution which some of these guys have operated. So retail side, governance is a big focus. Environmental and social is less of a focus. Institutional side, entire ESG package is a focus. Now the question is, how do you give weights to your environment and social and governance, given the limited data you have? So everybody has their own models, and depending on what is available, you give weights. So institutional side, I mean, without ESG, probably you can't survive. Client side, you may survive for maybe a few years, but I think it's an evolving trend.
Great. That's fascinating. Thank you. That's a very precise analysis for me. So I really appreciate it. Fabrizio, just turning to you for your final comments. Particularly interested, I think we all are, on the covenants behind green bonds and how we keep people honest as far as that's concerned. It seems to me that area is a bit spongy. What can one do as an investor to make sure that issuers of green bonds are doing what they say they're going to do?
Thank you, Paul. Well, I mean, I must say that we do a lot of research on the green bond market, and I mean, most of it is really good, actually. I mean, think about it. One of the reasons why an issuer issues a green bond is because, first of all, what attracts issuers is what's called a greenium. So they pay a bit less, and there's plenty of research we have on our website for free showing that greenium. The second one, which is very, very important, is reputation. Now, if you don't do what you said you would do, you kind of defeat the purpose of a green bond, honestly. So our research around, what issuers are doing with the money shows that actually it's pretty good. The thing is, again, is like, what is the promise that they're making? So what I mean by that is, what type of activities are they financing with the green bond? And that goes back to this question of taxonomy and the work that we do. So overall, I would say it looks pretty. It is pretty good. I mean, I can tell you that some of the data out there, some of the data that we produce around those green bonds are aligned versus not aligned, that investors are using. Actually, it's really important because this is the kind of data which feeds into indices for green bonds. So if you're not aligned according to CBI, most of the indices actually won't put your green bond in the index. So that's something to perhaps to look into. But overall, I would say the green bond market is actually we're very positive about it. Yeah.
Great, thank you, Fabrizio. I want to, Christoph, I'm going to do it to you. I want to end this panel on an explosive note. We've danced around political issues as far as ESG is concerned. I'm going to throw Russia at you, so to speak. How, from a sustainability perspective, do we treat political risk? What should we be thinking about? How has the Russia-Ukraine conflict sort of, obviously it's brought it to the fore, but how are people grappling with that as a problem?
So this is certainly a very relevant question, and war in Ukraine is absolutely a disaster on humanity, on the people affected there. So the sooner it ends, the better. From an analytical perspective, we certainly this kind of governance, also for sovereigns, is a very significant risk, as this example clearly shows. And we need to be available, aware, and need to assess that well before such horrible incidents do happen. And unfortunately, we see all over the world, even in democracies, what kind of weird people are elected as president, meaning the risk of similar things to happen, unfortunately, is going up. The question is now the discipline and the timing. When do you get out? So we, for example, we had zero exposure to Russian bonds or equity, which is certainly helpful because you cannot trade them at the moment. Yeah. So, and you don't want, as an ESG fund or sustainable company, to own these assets because, you know, it simply doesn't fit. It's not sustainable. But we need to look beyond where the next sources, and we are careful. And we do know that engagement with governments is much, much more complicated compared to companies. So when there's a roadshow for a new government bond, maybe at best you meet a finance minister, but would he kind of accept to your covenant wishes? I would say it's highly unlikely. So when the army kind of built up around Ukraine, we bought put options, equity put options, which we then sold after the attacks. And that with that, we managed to kind of hedge the equity market slump. And as we said, on a selection basis, we didn't have exposure to Russia. But we need to think about, because we want to help and to learn and invest in a constructive way. But unfortunately, in some areas of the world, we have to conclude, for us, it is too risky.
Christoph, that's perfect. I mean, I think politics is one of the dimensions that is. But I guess when I was a young man growing up in the investment world, we used to look at it more because we lived in a multi-polar world. And I think over the last 20 or 30 years, we've kind of forgotten that of all the risks we face, political risk is arguably the biggest. And I think we've just grown out of that habit of thinking about it. So thank you very much for that analysis. It's front and center in the ESG debate. We've run out of time. Christoph, Fabrizio, BD, Michael, a really brilliant, thought-provoking, energetic, educational panel. Thank you so much for all of your comments. I've really appreciated listening to you. And on that note, I'm going to turn it back to our host, Gayatri. Gayatri, over to you. Are you there?
Gayatri, yeah. Gayatri, you're on mute.
Gayatri, you're on mute.
Hi, Gayatri, you're on mute. Please, can you unmute? Gayatri, can you hear us?
Yes.
Oh,
Yep.
I'm so sorry. I'm on mute. All right. I was saying thank you so much. This was a brilliant panel, and we really found it very educative and very interesting. A lot of interesting perspectives and insights brought up. And thank you, Christoph. Thank you, Michael. Thank you, Fabrizio. Thank you, BD. And above all, thank you, Paul, for conducting it so beautifully. It was really very interesting and thought-provoking. Thanks a lot. So with that, I'll welcome our next speaker. Maybe Gautam, sir, you could invite her. Yeah, sure. Hi, Kubra, welcome.
Hello.
Hi, Kubra. Is Dr. Argudin here?
He should be. 1 second. He's just coming in now.
Yeah, very good. So he was there some time ago. So yeah, he's here.
Hello, everybody. First of all, thank you very much for your kind invitation to this important ESG webinar. we are going to present the Sustainability Governance Scorecard that was prepared by the Argiden Governance Academy, which is dedicated to improve quality of governance in all different domains. And Sustainability Governance Scorecard is basically developed to help speed up learning globally from global sustainability leaders. Next. Next, please. Okay, we conduct many activities as the Academy, and it's our main goal is to improve trust for organizations, which is critical for improving quality of life. Next, please. And our focus is not only on corporate governance, but also on public governance, NGO governance, global governance. And also we see governance as a culture to live together and build trusted institutions. That's why we are also developing programs for anywhere from 7 to 77 kids and all different types of generations. Next. Today, we have a number of different programs. You can check it from our website, but I'm going to focus on the Sustainability Governance Scorecard as the subject matter is the ESG Summit. Yes, please. The Academy also is the first Turkish institution to prepare an integrated report, and we are doing that since our inception. So we are trying to walk the talk with respect to transparency and being a trusted institution. Yes, please. The Sustainability Governance Scorecard has a number of goals. First of all, it tries to raise the awareness on SDGs on a global scale. And also with the motto that what you cannot measure, you cannot improve, we try to measure governance of sustainability efforts, not performance, but governance of sustainability efforts. The reason for this is that sustainability of sustainability efforts requires good governance around sustainability matters. And furthermore, sustainability performance is very context specific. It depends on the technology, geography, the environment in which a company operates in, and so forth. So it is difficult to find appropriate benchmarks for each company in that matter. However, how you approach sustainability activities is transferable across geographies, across industries. Therefore, we can learn a lot from many different companies when we look at it from this perspective as well. Therefore, that's what we try to measure. And I'm going to go over what we have found and how we did this. Yes, please. The first subject I would like to mention is that ESG, while a very broadly accepted acronym, is not doing justice to sustainability efforts. And I hope that in the future, this conference will be G's conference. Let me explain what I mean by this. Let's keep the previous one. ESG puts environmental and social and governance as an adjunct to financial reporting. Whereas what we need to do is to have an integrated thought process. This is one of the difficulties with using the ESG acronym. Second, environmental and social are not in the same domain as governance, because governance needs to be applied to all the activities, and it is not another item in the ESG. And finally, financial reporting is what the reflection of the economic activity and value created to a particular company, whereas what we need to focus on all the economic value creation throughout the value chain. Therefore, what we really need to do is governance of economic, environmental, and social impacts is the critical thing. This is why we feel that GEES is a better acronym than ESG in terms of giving us a much better understanding about how we should be dealing with the sustainability matters. Yes, please. In this particular research, we have analyzed from public sources almost 200 global sustainability leaders in 7 different stock exchanges, all of which are Sustainable Stock Exchange Initiative signatories, and in 10 sectors. And we have defined them as global sustainability leaders because they made it into various sustainability indices that are relevant in their own stock exchanges. Next, please. And what we are looking at here is how they are providing governance into their sustainability activities. For example, is there a policy, purpose and value creation model that incorporates all the aspects of sustainability, including environmental, social, and economic impacts? Are these matters being reviewed by their boards? And is the board providing appropriate guidance and oversight on all these matters? And are they providing the incentive systems for the executive management team to look into these matters in a proper manner as well? At the same time, do they have the capabilities to review such matters? And what we try to look at there is, do they have any sustainability experience at the board level? And are they transparently sharing a skill matrix that involves sustainability in there? And then what we look at is, how are these companies reporting on their sustainability matters? Are they providing, for example, targets, or are they just reporting on what they have done good? Because the latter could be written by PR people, but when you incorporate targets in your reports, it means that it has to go through the CEO's oversight and so forth, and resources are properly put behind those targets. And how about the scope of implementation? Is it covering only a number of different areas, a few areas such as water or carbon emissions, or does it cover the full range of issues related to sustainability, including the social issues and so forth? And how are they reporting on their results, especially if are they comparing it with their targets? And are they making any evaluations if they are falling behind targets as to how are they going to remedy this situation, and how they are providing linkages to SDGs? In a nutshell, what we are looking at is it part of their DNA as defined in their purpose and value creation model? Are they doing a stakeholder engagement in defining double materiality from the perspective of the stakeholders as well as from the companies? Are they covering all the impact throughout their supply chain? And is there a learning loop that is associated in their processes so that they can improve on their performance on a regular basis? Next, please. Therefore, global sustainability leaders, what we can learn from them, and even some of them are lacking in certain areas, this understanding, could provide us good examples as to how to approach to sustainability matters. We need to focus on sustainability by adapting a holistic approach, implementing continuous improvement, measuring efforts through fact-based impact analyses, and sharing sustainability targets transparently. So we have to have a shift in our understanding of a holistic approach to this matter. Yes, please. The results that we find is that particularly South Africa and Germany are performing a little better with respect to governance of sustainability. We divided about 200 companies into 5 different tiers. And it seems like tier 1 and tier 2 companies are focused more on these countries. And so we can look at different stock exchanges and these particular companies to learn from them how we can apply better governance on sustainability matters. Next, please. We have also identified it by industry. And what we see is that natural resources and consumer goods industries have companies who provide better governance on sustainability matters, perhaps for a number of different reasons. Natural resources investments are much more longer term, and they have to be much more sensitive about sustainability issues. Otherwise, their projects get into a lot of risk. And also there are stricter regulations around what they are doing. So that's why perhaps it's pushing them to provide a better governance on sustainability matters. And consumer goods are quite sensitive because of their consumers. They are putting a lot of pressure in these matters. So it seems like both customer pressure as well as regulation and having a long-term perspective on the activities that you are conducting seem to have a positive impact on how companies provide governance on sustainability. Another thing that we have identified was that voluntary initiatives tend to help companies over a period of time. And those companies who have adopted these voluntary initiatives, such as the UN Global Compact, integrated reporting, either SASBs or GRIs standards, because these are voluntary, at least as of now, although it's likely to change in the near future. Those companies who have adopted them are having a more integrated approach to sustainability, and it shows in our evaluations as well. As you can see, each country has a number of companies in different tiers, and especially the white ones are also getting good scores on the depth of not only coverage of their sustainability efforts, but also depth of their sustainability efforts. A lot more information is available publicly on our website. Thank you. Next one. The first item that we are focusing on is the responsibility of the boards. As I mentioned, are they providing appropriate guidance and oversight on the full sustainability matters? Are they providing incentives? And do they have the capability to do these things in a proper manner? Are being evaluated from publicly available sources for these companies. For example, okay, next, move please. Next one. Next, okay. No, the previous one, please. Okay, what we see is that although there is an increase in the first line in publishing skill matrix from last year to this year, from 36% to 54%, first time it passed the majority of the global sustainability leaders. Please note that these are global sustainability leaders. They made it into sustainability indices, that they are being traded because of their sustainability performance. Yet, even half of them are not providing a skills matrix of their boards, and only a third of them have sustainability as a skill they have listed in their skill matrix. Although this was only 8% last year, there is significant improvement there. There is big room for improvement in that area. And the India seems to have made a big impact in this case. Kubra and I had a visit in 2019 to India. They invited us to for us to share our reports at that time, and they were quite interested in the skills matrix. And last year they made it into a regulated regulation to publish skill matrix. I guess that is helping them with this significant development. But we really believe that it is important to give this publicly to increase the confidence of stakeholders to the companies. Next, please. In our report, although I'm not going to go into detail in all of these, we provide a lot of good examples that other companies can learn from. So it is not only the approach that we are measuring, but also many companies are doing good examples of these matters. For example, this one is a great skills matrix because it provides board diversity level of experience for general management and technical capabilities. Sustainability skill is listed with breakdown into governance, compliance, environmental, and health and safety matters. So it really provides a good example of how this board is capable of handling sustainability matters in their deliberations. Next, please. Another example is particularly with respect to their collective expertise, including diversity pillars and specific policies, tying them with their specific policies. It's a very good depiction of their board once you look at this one page, you can have a better understanding of the board's composition as well as skills that are encompassed in the board. Yes, please. Well, almost all companies share executive compensation information. However, when there are linkages compensation systems to various sustainability issues is still lacking. I mean, even the maximum is 28%, 30%. So there's big room for improvement in this area. Yes, please. However, once again, there are good examples of how sustainability targets are incorporated into executive compensation in a number of different companies. Next, another one. This one provides thresholds, targets, stretch measures on sustainability areas and linkages to their executive compensation. When we come to sustainability performance, I briefly mentioned this in the beginning, so we can move to the next slide. There is a big gap in terms of defining policies and setting targets. Almost all companies who have made it to sustainability indices have some kind of policy on their sustainability matters. However, providing smart targets is still a room, there's great room for improvement, even for these global sustainability leaders. Yes, please. Okay, next. However, there are good examples such as Linda from US, who is providing a holistic approach in target setting process that considers assessments of the company as well as stakeholder priorities in defining long-term targets, and shares the accomplishment status annually for each target and provides linkages to environmental and social and governance targets in their with their prioritization of their SDGs. Next, please. Here they tie it with the SDGs, as you can see. Okay. So one area for further improvement still is that target setting is generally made for companies, their own operations. However, they have very significant impacts with their purchasing decisions, with their partnering decisions, their choice of suppliers, and so forth in terms of sustainability. So considering their whole value chain and ecosystem and providing targets for those could actually help the carbon emissions, the water, saving water, and so forth on a global scale, a lot more than what one can do in their own operations. Furthermore, this kind of an outlook can provide innovative solutions which are much more economic, because there are significant room for improvement when you look at it from this perspective. Let me give you an example. You may have to invest significant sums to reduce water utilization in your own factory. However, if you look at the whole value chain, you may have to redesign some of your products so that their water utilization throughout their life cycle could be improved much more significantly. And that this might be even more economic. If you further raise your perspective and look at the water basin that you are looking into, that you are pulling from, there may be only some training programs that may be applied to agriculture, which is a source of terrible utilization of water. And you can save significantly more water with only training and very economic manner in your water basin. So the way we need to look at it is from the value chain perspective and ecosystem perspective to make a bigger impact on the sustainability matters. Next, please. And there are good examples of these as well. For example, this Indian company is sharing Scope 3, defines their Scope 3 results and targets, and pulls it into different categories, shares this long-term target about emissions in a data-based manner. Next, please. And prioritizes stakeholders, defines engagement methods because this engagement, stakeholder engagement, is very important to be able to identify these potential improvement areas as well. And this particular company is reporting on those matters as well. Next, please. And this one is allocates a CSR budget for stakeholder consultation and improving their understanding of the issues. And also allocates some budget for impact assessment on material issues, which is very important because if you don't measure, you cannot improve. Yes, please. Kubra, I think I would like to leave at this point to you to get some information about how companies are dealing with the SDGs, which is a very important area. Although 5 or 6 years have passed, we have long room. We have a lot of room for improvement in this area. Thank you.
Yes, I'm happy to move forward. So as Dr. Agda mentioned, this slide is about SDGs. We also analyze about how corporations are dealing with the SDGs. In 2019, the UN Secretary General had talked about the fact that there is a purpose action gap. So as part of our research, we drew a picture of this gap through public reports. And accordingly, at the moment, there is a more positive trend towards adapting the Sustainability Development Goals compared to last year. However, as Dr. Argidan just mentioned, there are indeed some opportunities for improvement, especially regarding also sharing the results. So they are linking, corporations are linking their strategy to SDGs. However, are they actually also publishing the results for it? And I just want to quickly mention here the SDGs that are mostly linked, and those are SDG 13, climate action, SDG 8, which is decent work and economic growth, SDG 12, responsible production and consumption. Those have scored highest in terms of getting picked up, and the sustainability development goals with the lowest alignment were SDG 14, life in water, and SDG 16, peace, justice, and strong institutions. In fact, these are critical areas where the contribution of the business world must be strengthened. If you could move to the next slide. Thank you. So this is another chart that points out to goal action gap, focusing on regions. And here we looked at the companies in different geographies to see if they indeed link their strategy and at the same time share those results. And according to our report, all South African companies link strategy with their SDGs. Turkey has a rate of 93%, and then the rate is higher than 80% for Germany, for the UK, and for the USA. The countries which have a lower rate for linking strategy to SDGs are India and China. However, the highest gap between the linking strategy and sharing results is in Turkey and followed by China. And the most minor difference in alignment of strategy and results is in Germany. Basically, what we are trying to achieve here is that German companies link their sustainable development goals with their strategies. Then they also fully publish their results for their contributions. And in other words, we can say that the unity of purpose and action is in fact highest in Germany. If we could move to the next slide, please. Another issue we examined is a goal action gap for sectors. Here we examined the sectors that link their strategy and whether they consequently share the results, but on a sector basis, as I mentioned, and we found out that machinery and equipment, automotive and pharma sectors are the ones with the lowest gap between strategy and results alignment. Next slide, please. So this table shows which sustainable development goals various sectors have adopted. So if you could see a box in color, that goal has been adopted and linked with at least half of the companies in that specific industry. So here in this case, SDGs with numbers 5, 7, 8, 12, and 13 have been adopted by more than half of companies in almost all industries, with the exception of a few lagging sectors. And these SDGs are then again gender equality, affordable and clean energy, decent work and economic growth, responsible consumption and production, and climate action. Next slide, please. This is a good practice example from China. The name of the company is called the Hong Kong and China Gas Company. It's a utility company. In this example, the company, we can see that the company prioritizes and focuses on the 4 SDGs where they think that they have most impact on society. So potential positive and negative impacts are listed for each selected SDG, and actions and results are also shared, supported with numbers, which is what we have been looking for in our research. For example, they specified the goal of providing safe, clean drinking water to 2.38 million customers, which is then a positive impact on society. And then, but they also mentioned about producing the wastewater and gave numbers, which would be then a negative impact on society or an externality. Next slide, please. This is now our section called Sustainability Journey. And here we include an analysis on the topics of value creation, materiality, supply chain, development, and learning. Next slide, please. This is a table on materiality, and our results show that 89% of the companies share a list of material sustainability issues, and 90% share the process for selecting material issues. All companies in consumer goods and more than 95% in natural resources share information on materiality. German and Chinese companies show outstanding performance in various areas of materiality that we have examined. However, all countries have the potential to improve when it comes to sharing a materiality matrix, because only half of the companies that we have analyzed have actually shared a materiality matrix. Next slide, please. This one is a good practice example from Evonik. This is a German chemical company. As we all know, it shares a materiality matrix for various ESG topics. And then you can see on the chart that it highlights the top 3 and then also the top 10 sustainability issues, both for the company and as well as for its stakeholders. Next slide, please. This slide is about supply chain assurance. Basically, leading companies take responsibility for sustainability, not only for their own operations, but also for the supply chain. They encourage their suppliers so that they implement the same sustainability approach. This is important for the adaptation of the culture throughout the entire value chain. And we also evaluated, of course, the companies in this regard, and we based it on publicly available data. Our results are the following. 96% of companies share the supply chain audit process. Within these audits or controls, 85% of them make evaluations according to the ethical principles, compliance or declaration. 84% do internal audits. 62% of them have even third-party verification, and 63% of them look for certification. Next slide, please. This slide is a good practice example from Turkey. The company is called Migros, it's a supermarket chain, and this is on the topic of supply chain. Currently, global standards are indeed increasing in terms of auditing suppliers. In this example, the supplier audit covers various ESG issues. With the help of the SEDEX audit, product safety, ethical issues, environmental issues are all evaluated. And in this case, that from the evaluation that Migros did, out of 500 of their supplier audits, around 80% were found to comply with their audit standards. Next slide, please. Actually, with this slide, I would like to switch back to Dr. Argidan.
Okay, in a nutshell, thank you for listening to us. In a nutshell, what we want to repeat is that ESG is not necessarily the best acronym for looking at sustainability matters. because we have to have an integrated approach to looking at economic, environmental, and social issues, including policies developed and approved by the board, all the way to incentive systems and completing the learning loop by comparing with targets where we are and what type of measures we are taking, and transparently sharing this information with all the shareholders. Therefore, we need to shift our understanding into G's from ESG. And our report is quite detailed. We provide many more examples by reviewing the publicly available information from these 200 global sustainability leaders. I would recommend you to take a look at our website, ergudenacademy.org, and also Sustainability Governance Scorecards, both publication as well as on our website. Next, please. These are our social media accounts. Next. And next, please. And we are collaborating with a lot of international and local institutions in developing different methodologies. Next, please. And I would like to thank our donors for our foundation that enables us to conduct such research and numerous education programs. And next, you can find our number of different years sustainability governance scorecards at the link that is listed here. Thank you very much for listening to us, and we appreciate the opportunity to share our research with all the people. Thank you very much.
Thank you, Dr. Erguden. Thank you, Kubra. It was a very interesting session, and I think this governance scorecard is going to act like a framework that will be helping organizations actually plan their governance strategy going forward. And as you rightly said, ESG as an acronym doesn't do justice with the kind of integrated approach that is supposed to be taken when it comes to sustainability. So as we move more and more towards implementation and adaptation, it is required that we improve.
So next year we are waiting a G's conference from you.
Definitely. We will be looking at that. In fact, this conference itself is going to extend till September, and we will be progressing on the conversations that are happening now. So in September, we will do the concluding sequel of the same. All right. Thank you so much once again. It was a truly our pleasure to host you, and I'm sure that audience questions we will be looping back again. Thank you so much.
Thank you. Bye-bye.
Bye. In the meantime, there's a humble request to all the attendees. If you have any questions, you can always write to us. There is a Q&A section, as you can see, and there is a chat section. You can always post them here, and we can also unmute you when you have a question to ask. So please feel free to drop in your questions anytime.
All right. Welcome everyone to the session on accelerating SDGs with good governance. My name is Sivanand Ramchandran, or Siva, and I'm a Director of Capital Markets Policy at the CFA Institute. Just as set the background, Sustainable Development Goals, or SDGs, were agreed to by UN members in 2015. As a replacement to the UN Millennial Goals, right? It's a blueprint to address key global challenges, including those related to poverty, climate change, inequality, peace, and justice. The 17 goals of SDG, including no poverty, climate action, and life on land, are all interconnected and particularly aimed at governments. Despite the goals and targets not directly applicable to businesses and investors, SDGs have become a powerful framework for these groups, and some investors are already reporting against their impact on SDGs and allocating capital to contribute to their achievement. In this session, we will be talking about SDGs with a particular focus on governance. We have a distinguished panel who could provide a diverse perspective on SDGs. I am joined today by Ulrika Hasselgren, Chief Sustainability Officer at Cheli, a Swedish asset manager. Ulrika is a senior business leader and a certified board member with long experience in both the finance industry and in the area of responsible investments. Welcome, Ulrika. It's an honor.
Thank you.
I'm joined by Megan Fallon, Chief Investment Officer at Innoterra, a Swiss-Indian food and tech platform company with a commercial footprint in 14 countries. She's also the founder of Step Up Advisors. Megan is a social entrepreneur, thinker, design strategist, and explorer. From whatever I've seen, she probably knows more about India than I do. Welcome, Megan. And lastly, we have Andrea Webster, Finance System Transformation Lead at the World Benchmarking Alliance, or WBA. WBA allies represent organizations working at global, regional, and local levels to shape the private sector contributions to achieving SDGs. To that end, WBA has developed benchmarks that will compare companies' performance on SDGs. Welcome, Andrea.
Can you hear me?
Yes.
Perfect. Thank you.
Thank you. Without further ado, we are just going to dive into the conversations. We have plenty of things to discuss, so I won't, speak any lot more than I did already. I'm going to start with Ulrika. Ulrika, historically, so today's session we talked about ESG investing as one of the sessions, and and historically, when institutional investors talk about ESG or integrate ESG, what they mean is financial materiality, right? So, or how investments, how ESG issues impact the risks and opportunities when it comes to investments. But then the focus conversation has also been shifting towards impact materiality. Very recently, the concept of double materiality was introduced. And can you talk about the distinction between financial materiality and impact materiality? And it seems like the issues must have a very strong overlap, right? But potentially, what's driving this change towards impact?
Great. So first of all, I'm very happy to be here, and thank you for inviting me. So on your question, I think it's I very much agree with how you phrase it, but it's also a bit of a challenge in the institutional investor space over the years, because investors has for many years implemented different policies for sustainable, responsible, even ethical investing. So in my home region, the Nordic, Scandinavia, this is very well embedded. So investors are used to require from their fund managers to integrate sustainability, from a financial materiality aspect, but also, and in parallel, and also sometimes confusing, looking at sustainability from how should I say, from an ethical perspective or a values-based perspective. And I think this is where it gets a little challenging, because most investors, we can say, are doing it, but what they're doing is sometimes getting a little mixed up. And I think that the case for materiality is very well embedded in most investors and asset managers' investment thinking, because it makes investment sense.
Right.
But if you have an institution who has a set of values guiding their whole mission, they might be driven by ethical values or missions that are separated from the investment case. So here we have a bit of a dynamic space, we can say, to be clear on what we do and what not.
Right. So I guess, just to follow up on that point, right? So I guess the ISSB came out with this, sustainability disclosure standard, and even there, the focus is mostly on financial value, right? But we know that, I think, at least like if you see the news commentary last few months, the conversation, the commentary has been shifting towards impact, like, forcing companies, like, how like, or investors, how does your investments impact the society and so on. Can you talk a bit about the drivers, what is driving the shift from exclusively financial materiality towards this impact?
I think there is a very clear realization of, let's say, the real world and what is going on in the world. We have an energy crisis. We have increasing challenging situations in our societies. We have, of course, currently we have the war in Ukraine, which, of course, from a Nordic or Northern European perspective, is very much sort of, it's, the reality has come very close. That means that investors looking for, let's say, impact investing and really contributing to societal good or to contribute to solutions for sustainable development and for society and such, are really faced with a sort of reality check. We're talking about energy transition. This is all about net zero. How we get to that net zero is kind of debated, because sometimes you would see investors saying, I want my portfolio to be green. So you have a green portfolio because I want to support the energy transition. But when you look into that portfolio, it contains everything but oil and gas, and a majority will go into pharma and fintech and Netflix.
Right.
That does not solve the energy transition, right? But it looks green. Yeah. So I think that the impact is really, being discussed now to say, okay, what does real impact mean from an investment perspective, and what can we do?
Understood. That's great. So I'm going to turn it over to Megan. Can you, so you, are associated with the food and technology startup, can you talk us through, how a business model or an initiative aligns with SDG, but more importantly, how do you assess impact, or what kind of metrics do you collect to assess that impact?
Mm-hmm. So thank you very much for the privilege to be on what I consider a gender balanced panel for once. Very happy to see that. Very progressive for India. I'm usually the only woman on the panel to the gender equality SDG.
The token man. Yeah.
Exactly. And that's a great balance, and you're doing it proud. So I think because I've come between for-profit and the not-for-profit social enterprise world, I've had this very unique opportunity to have more than a decade to learn to build value into everything you do. And now to step into the for-profit world and to start to look at how do we build our business models? Because for me, that's really where it starts, right? I don't like to think about impact in a silo. I like to think about how do we use the best skills, materials, technologies, thinking that we have in the private sector, and how do we turn that inward to say our job is to create value, not just for our shareholders, but for every single place in the supply chain. And are we brave enough? Because I do think it's a bit about bravery and fearlessness. Are we brave enough to step up and really look at what we're doing as companies in a quite deep way to say, am I creating value for the planet, for the people who supply the things that I'm going to sell, and ultimately for the consumer, because that's the real impact, right? When the consumer benefits from having a value chain that is laden with those opportunities, that is value, really, and impact in the end. And of course, some businesses, unfortunately, are are in sectors where that's very challenging, right? Agriculture happens to be one that has a lot of opportunities for that because we're focused on smallholder farmers. And one of the things that I have been working on with Innoterra is how to develop a digital learning management platform for smallholder farmers. Now that sounds sort of funny, but actually it touches about, I think it's 1, 2, 3, 4, 5, 6, 7, 8, 9 SDGs. Right? So that's about building a mechanism that will enable and strengthen your supply chain by capacity building smallholder farmers in specifically the science-based practices they need to evolve what they're doing in more regenerative and holistic ways. And also to help them gain the confidence they need to be able to make better decisions about the inputs that they use on their fields. So whether that's fertilizers or pesticides or other things. And so helping them to really become resilient, which in the end assures our business model, right? Our business model falls apart if our farmers are hammered with, storms and unseasonable drought and other challenges. And if we don't give them the tools to be adaptive to that, then we're hurting ourselves in the end. And I think we're going to see over time much, much more of that sort of consequential thinking needing to be an upstream process to mitigating risk, because that is the biggest cost to most agribusinesses, obviously, is what's happening with climate change. So, I mean, that's just an example of how we chose to kind of go at it. And it's funny because we have had a lot of skeptics from inside the company. Is this really where we should put our money, right? Because it feels a little counterintuitive, as Ulrika was saying, some of the moves that we now need to make in the private sector are somewhat counterintuitive. Yeah.
Understood. Interesting. So you mentioned about digital learning platform and so on, and you said it touches upon potentially 9 SDGs, right? So what kind of, how do you assess whether those programs are delivering what it is supposed to deliver? How do you measure that?
Exactly. So this is where we have to learn between silos, right? So the social enterprise world uses something called a logical framework when it assesses whether or not a development agenda is going to have the outcomes and outputs that are sought in that sort of program. And so I actually took that and applied that to us in a corporate sense. I looked at that logical framework and I said, what are our inputs? What are our activities and our actions? In essence, what are we going to do? And then what are the outputs and the outcomes? And then it was quite easy to actually come up with, okay, how are we going to measure those outcomes? Because that's what we want to know. Is that really happening? But it also gives us an incremental way to assess ourselves in terms of, okay, maybe our activities are great, but we're not getting the right outcomes. Okay, we don't change our activities. We have to strengthen then the places that are weak in that. So it also works a little bit like a forensic. To be able to come back at the initiatives and say, am I really getting where I want to go? And again, that takes a thinking about which data. It's a lot around data now. We have to really be conscious about data. And companies collect huge amounts of data, but often the data doesn't talk to each other, or the data doesn't get extrapolated as a way to back up an impact you're having. So, can you really look at those data sets and say, oh my gosh, as I did, I realized we were collecting all kinds of data and not telling the world that actually we were doing those things. So I think in so many ways, it is very important to have a team dedicated to these areas of impact and ESG that is not sort of in the hands of the HR department as a part-time job. I would really advocate for, finding dedicated, qualified resources who actually can come in and really can understand how to put that lens onto everything that's being done. I think that's worth a lot of money. And then I would just come back to one thing that Ulrika said, which really resonates with me. I strongly feel that until we are able to put a value, a monetary value on those social impacts and the more qualitative impacts, we will not move the dial with investors, and we will not move actually the dial in companies until that transparency is there to the outside world to be able to compare apples to apples, oranges to oranges, and until we are able to see on the labels as consumers, this is a 5 versus a 1. I think we won't get that real transformation that we need to unlock the right money to the right companies that are really championing that way forward.
That's great. So we'll touch upon some of these things, but I want to switch to Andrea. So World Benchmarking Alliance, right? So I looked at some of the work, and there's a lot of work going on in different sectors and trying to come up with how companies are doing on different SDGs, in different sectors and so on. Can you take us through an example of can you take us through a methodology within the financial sector? How do you kind of assess the SDG for companies within that particular sector?
Okay, I'm just going to set some context here as well, and it's inspiring listening to both Ulrika and Megan, so thank you. I actually come from the finance sector, and I've stepped into the World Benchmarking Alliance. So I have 20 years asset management and life assurance industry in Asia, so I'm a finance person, and I'm looking forward to the debate after this as well on some of the points that you've made about how we move the dial. And I think it's about, there's some points on narrative as well. But to answer your question, Siva, I think I'm going to take a step back first. And for those that aren't familiar with the World Benchmarking Alliance, because obviously scoring and mapping the SDGs is hard. So I think, and you've talked about transformation, Megan, and what we're looking at is system level change. And for system level change, you need system level thinking. And so the starting point for methodology and scoring is to identify those systems. So when you look at what the World Benchmark Alliance has done, obviously this is a focus on private companies. So we are completely the opposite end of the scale. We're on the top end, the top 2,000 companies in the world that we think have an influence on the SDGs. And so we're talking mega scale here. So we've identified within the system change, we've broken it down at 7 levels. We've got, at its core, the social system. Within that, we've got various sectors, which me as an investment person, I can relate to, and I think with the CFA audience, they'll relate to it as well. We've got decarbonisation and energy, food and agriculture, nature and biodiversity, digital and urban. And these are all the systems that we feel are crucial for societal living. Wrapped around all of those is the finance system, and that's the benchmark that I've got. So, and so that's the starting point. It is a challenge scoring across not just different sectors, but this is also global. So to give you an example, within the finance sector benchmark, it took nearly 2 years of consultation with multiple stakeholders to define this benchmark and to define the methodology, because for it to be useful, it's got to be relevant. And therefore, as well as civil society and policymakers, it's got to be adapted by the finance sector. There was if we're going to go from millions to trillions, we need markets on side. So within our methodology, we've broken that down into 3 sectors: governance and strategy, respecting planetary boundaries, and societal conventions. And then within those, we're very keen that we don't want duplication. We don't want to replicate everything else that's happening in the marketplace. So we then turn to globally recognized frameworks and then set the indicators within those. I think there's an overlay in there as well as the maturity of some of the issues. When we look, we can go back even just 3 years, that some of the solutions we've got now on climate didn't exist on science-based indicators. So whilst it's still complicated, recognise that there is more clarity. I think perhaps in some of the social indicators, there's still work to be done. So we try and work the methodology so that it's fair, but it's aspirational, and it can be applied in a global context.
Understood. So maybe kind of goes back to this, I think you mentioned about using existing frameworks. So that kind of resonated with one of the questions I was going to ask you is, so there are many companies respond to like requests, right? So there are standard setters, and there are data providers, and there are organizations like yourself and so on. Everyone makes requests for data. They all have different frameworks which are quite similar, and what's the and then there is a fatigue for responding to those requests, and so I suppose is that having existing frameworks somewhat helps there, doesn't it?
I think so. Yeah, and I've got empathy for that, having come from a world where having to work out how we score and answering questions and allocating resources when you've got a team and you've got to guide them on what they respond to and what they don't, and obviously you've got regulatory requirements and also what investors are asking and demanding of the finance system. So we are cognizant of it. When we're doing a methodology and a benchmark, we had to draw a line in the sand to be able to do the scoring, but we recognize this is just the beginning. I think, Megan, you made a great point about data, that you gather it, but you've got to use it. And there was a wonderful comment that was made in the first session about data as a marathon, not a sprint, and it's eternally improving. So when we put that line in the sand, we looked at the existing regulatory framework, but we also tried to have an anticipation of what's coming as well, what's in the pipeline. Obviously, TCFD is in that. I promised myself I'm not going to use the alphabet soup, which everybody criticizes. So climate reporting is there, but it's moving beyond that now into nature and biodiversity and obviously social metrics post pandemic. So we're cognizant of it. I think when teams are getting stretched of what to answer and what not, I think it depends on, we're all on a journey, and we're ultimately all going to get to the same place that Megan has mentioned in terms of, to move the dial, we have to move the markets, and this will all become priced in, but we're not going to get there overnight. And what I hope is that this is a tool to get us there. So we are broad, not deep. And when we talk about governance, and we'll probably touch on this later in the discussion, but the guidance comes from above. And depending on whether you're in an emerging market, developed market, or if you're based in Europe, you're in a different stage of that journey, and whether you need to go broad or deep. So I think for those at the beginning or looking where to start, I think our methodology with the World Benchmark Alliance is a great starting point because we're broad. I think that the idea as well is to avoid box ticking. We ask questions in such a way that they can be answered openly, and this is about having a policy, tracking the policy, and reporting on the policy, and having transparency. So I think the individual teams and your audience here will have to decide their priorities depending on who's asking the questions. Is it regulatory? Is it an investor? There's probably a strategic overlay there, and then whether they want to go broad or whether they have a particular focus in the strategy to delve in on climate or social issues or gender. I think it might be worth mentioning for listeners that there's the Impact Management Project, which is an initiative that's going on to try and unknot all the different reporting mechanisms, and that's due out, I think, in the coming months, with some online tools to help guide people what they want to achieve with their objective, and it'll point them to the right framework. So I hope that helps some of the audience.
Understood. Since you mentioned, I think in impact management, maybe I'll come back to that. So you also mentioned about developed and emerging markets, and whether it's applicable for both. I'm going to turn over to Ulrika and ask, what are the challenges when it comes to aligning investments with SDGs, and are these challenges similar for developed or emerging markets, or is there different challenges when it comes to aligning investments with SDGs when it comes to emerging markets?
So what I would pick up also for this question, the issue of data, of course, as we know that in developed markets and in particularly some regions, data is all over, right? So we have the volumes of data, but we're lacking the the quality of data and also the usefulness of the data for investors or investment managers. So I think this is a challenge that goes across all markets, and in relation to emerging markets or even frontier markets, of course, the issue of data or the lack of is an issue. However, for managers who are active in the space, I think that, you know, I want to share one example in emerging markets, you know, in relation to data and the SDGs. But you know, we're in a situation where everyone is talking about ESG risk. ESG risk. So this is a very popular thing to talk about, ESG risk. But not many are able to really define what that ESG risk is and what type of risk it is. We have established financial risk. And from an investor perspective, that would be anything that would negatively impact the share price, right? We can also talk about non-financial risks, being management risk, operational risks. And then comes the question, so if we know what financial risk is, we know what non-financial risk is, then what is ESG risk? So I think we're sort of in a situation where we need to be clear on the definitions. And I think that it's not a one size fits all. I'm very much supporting the idea of sort of a global framework, a global standard. On the other hand, I'm thinking no one would ever say or ask for one way to invest in listed equities. There are many different ways. But on the sustainability side, on the SDG side, on the ESG side, we're all looking for one solution, which is not always helpful. And if we look then into emerging markets or frontier markets, we're managing a frontier market debt strategy. So we're financing countries in the frontier region. How can we be a responsible investor into this region? How can we contribute to sustainability? What we have done as one example is that we're focusing on supporting gender equality in this region. So we believe that gender equality in leadership, this is good governance. It's good for the country, it's good for the society. So we also then say, okay, so how could we do something in that space? Well, we know we have the data here, and this is very important. We have data on the number of women in parliament across these countries. So looking at countries from Papua New Guinea to Nigeria and then just sort of the full spectrum, we have the data on women in parliament. So what we are trying to do is to promote women to take a seat in parliament in these countries. We as an investor we're an active investor. We have the relationships with key people, key positions. So we can also have the dialogue on governmental level. So this, of course, would then contribute to SDG number 5, as an example. And of course, this is not by no mean any quick solutions, but this is what we have identified for this region as something concrete where we have data, we can work with the data, we can work with our investment and try to contribute to a positive outcome.
Understood. May I follow up on
they measure
if you are looking at
where the company needs to get to in terms of its impact, and it's even the best performing companies.
Understood. apologies for that. So if you translate an SDG to a particular metric and you're trying to engage with that, right? Like, once again, like, my immediate, this thing is box checking, right? So, how do you know that it is like, it is implemented in a way that is within the spirit of what you intend to do, and potentially that can lead to the positive outcome, which might be like, gender equality for the whole country rather than like, just within the parliament and so on, right? So is that, is that when you go from an SDG to a metric, like, and perhaps like others can chime into, like, is there a worry that the focus on metrics can lead to, once again, the issue of box checking, and like, so that again.
Yeah, we would do our utmost to refrain from the box ticking exercise, which is a challenge, I think, for everyone. But I think that given that we have the data and we can also put this into our own spreadsheets and follow the progress, and also then understand how this affects the country, thereby the debt, so I think that this is something that we can then also focus on supporting countries to issue a social bond or an SDG bond, or particular that would sort of be part of that solution. And then, of course, over time we are able to measure the progress, of course, on the number of women, and then how that plays out in the society of these countries.
Okay.
That's not what we do.
I wondered if I could just pose just a comment on risk. Sorry, because you've touched on something that's really close to my heart, is that I think my experience historically is that the ESG so much has obviously been focused on risk management, and a lot of the regulatory framework is based on risk management. But I think we have to move away from it. And your point, the points we made about value, because I do think we need to take risk. If we're going to achieve what the world needs to, we need system level change, and system level change needs courage. It needs new ideas, and by virtue of that, it means taking risk. And I think from a governance perspective, there needs to be scope to take good risk and identify and alleviate bad risk. So I think it's really important about narrative and choice of words, about how we talk about risk management.
Yeah, I would love to build on that, because I think it comes back to governance always, right? Governance at company level is absolutely underperforming in this area of ESG and risk taking, because that's actually our job as directors of companies, is to ensure that the transparency is there, both on the validation of practices and of impact, but equally to encourage and to empower executive teams to take the risks that they need to in order to move the dial. And especially important when you start talking about systems change, which requires a level of collaboration that unfortunately most economic systems are not wired for in the private sector. They're not wired for that kind of radical collaboration, and that really focused on coalitions that will bring systemic change, because that means working across sectors, and it means working across industries, and it means potentially working across some in imperfect systems. And so that takes a certain amount of risk. And I think without strong governance, that's always where I go to. Without strong governance, without that giving of authority to executive teams to take those kind of steps, you're really stuck in the water, right? And it connects back to something Ulrika said, which was, negatively affecting the share price, right? So I'm going to be a little bit contrary and say, I think we have to stop this complete addiction to worrying about the share price. We need to be worrying about the health of the company. Is it really creating value? Is it really moving the dial? Is it actually having a positive contributory and regenerative, kind of effect and impact, that's really when we will start to get the dial change. I think as long as we're running after shareholders, everybody knows we have to respect the need to, earn reasonable returns, but the time has come to just stop that kind of shareholder driven mentality. I think it's really unhealthy, and it is going to force boards to not take risk in exactly the way you're saying that they need to empower companies to take. So something in that cycle has to shift kind of radically now, or we're just not going to get where we want to get. Go ahead. Yeah.
I'm going to say one thing, and I'll hand it back to Siva because we're mutinying the panel. We have.
The panel is hijacked.
If I can give you some hope, because I stepped out, there's a G20 finance working roundtable going on today, and I've stepped out of that to join this. And there are some incredible minds in there, and I can tell you that is part of the discussion.
Amazing.
I have a huge, there's a lot of work to be done. There's collaboration needed, but it's there and it's being discussed. There's policy setters in there, and there's some of the heads of some big global institutions. So there's hope, trust me.
Great. Love to hear that.
So I'm going to go back to something Andrea said about impact management project, and there is something that is coming up right in the month or so. And I also go back to Ulrika, who said that when it comes to I think it was impact, everyone wants one standard, right? So people like to have some degree of standardization, and that's not the way to do it. So Megan, from your perspective, right? So when it comes to sustainable food, or in the business that you are in, can you talk about how impact frameworks are evolving? Now, the related question is there a potential way to assess this business in a standardized way, or you think that that's not the way to go about it?
No, sure. I would say one of the challenges is that there is too much. There are too many fragmented ways and frameworks that you can report against. And so everybody in the agri-food business can take their own sort of approach about whether they're going to actually, what they're going to measure and how they're going to measure it, and what is impact to them. I think I can only speak from our point of view at Innoterra. And, we're really, really concerned with, are we able to produce healthier food for people? Are we able to do that in a way that is protective, steward, mindful and regenerative to the planet? And are we able somewhere in there to address the system of the food industry in a way that is more positive? And we've been looking at a lot of ideas about how we can transition some of the logistics parts of our business to a more sustainable normal. Whether that's using electric vehicles, whether that's starting to think about other kinds of circular, mandates for the company. We will go to a low to no plastic, criteria for this year. So we're looking at the materiality, frameworks of everything from B Corps to SASB and now ISSB. And I do think, just to come back to that ISSB framework, I fully I know from some other committees that I'm on that there will be a second round that comes out that is totally focused on the non-financial side of that. So that's in the work, and that's definitely planned to come out. And I have a lot of hope for that ISSB framework, not least of which because Monsieur Faber is at the head of that now, and I really think his vision is pretty extraordinary. But also because I think it is helpful for large players in the global systems, in my case, food systems, to see that unified kind of criteria and approach. It's not so much from the standpoint of is it perfect? They're not perfect. They're not so detailed, but it does help to have people who aren't so comfortable in having a conversation because they're not expert in that area, able to start to engage with the language, think about the categories. It's a process, and we have to bring everybody along on that process. You can't just slap down policies and then say, right, everybody do it. We need business leaders to really understand, what does it mean? What does it mean for me? Where do I have to go? My experience is that if you can give people a clear vision of what the new normal looks like, business people are super creative. That's what they do. We're entrepreneurial, and they, can adjust to those realities and constraints. That's all about what free market has built in our, societies. And so how do we put them at the right thing? How do we put them at the right vision, put that out there? This is what it looks like. This is where you need to go. Okay, now go. And can we incentivize them to do that enough? Are we thinking about both the penalties, the policies and the criteria for constraint, and also the incentives? And I think we have not focused as a community globally as much as we need to on the incentives for doing it right and being transparent about that. In fact, the entire shareholder construct creates the opposite for that, which is troublesome, because when people move that way, we need to reward them for doing that and not put them in the hot seat. And I think we're going to see a lot of disruptions on these frameworks, because I actually think that we have a younger generation who are not going to compromise, and they are making that super clear in their behavior, in their buying habits, in their consumption habits. And I think we're underestimating the power of that in the next 10 years. What's going to happen when they come into that really dominant position as consumers and buyers and investors. I think we're going to see a lot of pressure there that we haven't seen before, and that I think will probably take us away from one size fits all frameworks and into a more fluid system of being able to value different regenerative impact practices in large and smaller ways, I hope.
So I'm going to comment again. I apologize. Just on that, sorry. I think your point about disruption is really key, and the finance system has such a huge role to play on that. What we have to be aware of is unintended consequences. I mean, we don't know what we don't know, that famous saying, but the finance system is incredibly smart and incredibly efficient. And when the pathways are open for money to flow, it will go to the right places. And what's important, is it's just. And I think that's what it has to happen quickly, but it can't happen too quickly.
I understand.
Yeah.
So I'm going to just take a detour and ask you a different question, right? So, and I'm going to start with you, Andrea, but I'm probably going to ask Ulrika, Megan, the same question. Are there trade-offs between different SDGs, right? So I think there was a book called Greengrocer, which I read, and the author Richard Walker, the CEO of Icelandic Foods, he said that, look, we are serving underprivileged neighborhoods in UK, and we thought about introducing cage-free eggs, right? So whether to introduce cage-free eggs, which is an important sustainability issue, and then we decided no, we are not, because it's just too expensive for our customers, right? So that is affordable nutrition, right? So I thought there are lots of trade-offs when companies make decisions, and sometimes they have to prioritize, right? So I think Andrea, if I may ask, when you come up with benchmarks, have you encountered these kind of trade-offs, and how does that inform the methodology and this process?
It's an evil question, Siva. I will do my best to answer it. I think the trade-off, it's about timelines and long-term thinking, which Megan probably links into your point again, and moving away from short-term thinking. I think my belief is that this will get picked up within the governance indicators and the scoring, because if you've got good governance and policy in place. I think sustainability strategy comes from the top, and that will drive the hierarchy of decision making. And so if there's clarity on that, then that's that it will flow downwards in terms of where focus is and where the compromise is. And I think if you're thinking longer term and longer term value, more of those trade-offs, there are less trade-offs to worry about, because over the longer term, everybody wins rather than the short term. And so I think, and that probably goes back to the good risk versus the bad risk, and new solutions and new thinking. I think personally, and I've got to overlay this, because so from a methodology and we score it, we'll be looking at policy, and we're not going to judge on whether they're doing the right thing, because that varies so much by sector and by regional, and there's so many variables to it. But I think it's about there being direction for the big wins and not the easy wins, and how that decision making is communicated out to the wider audience, so everybody's clear on what a corporate's doing and why.
Understood. Ulrika, so if I may pose the same question, right? So when you engage with companies and potentially talk to them about the impact they are having on a particular issue, have you ever come across the turnaround and say, but what about the other impact, right? So which we have to kind of balance, and there is potentially always there are issues that compete in terms of priority for different companies and contexts, right? Can you talk about that aspect from your perspective as an investor?
Well, I think if I was to pick one of the SDG, I mean, it's actually it's very difficult to say which one is most important. But I think that currently we have an energy crisis, at least in Europe, but I think also around the world. And I think that solving and working very actively towards transition, the energy transition, is key, because that also impacts societies and countries globally on a number of matters. And I think that the real impact, as I see, on that particular topic of working with the energy transition, is to really have skin in the game, stay invested, and use your investment, use your power as owner in these companies to push for change, but also support the transition, because currently the world is, we're 80% dependent currently on fossil fuels.
Yeah.
And we're transitioning, and we want to see companies scale up on renewables, solutions, energy, all of that. While we're doing that, we're using fossil fuels, right? And if we were to say that everyone should drive an electric vehicle, if we can have everyone do that, that's going to reduce emissions by 8% or something like that. I don't have the exact number, but there's something like that. Yep. So the whole world is actually, the future is dependent on our energy transition, and that we can also make sure that countries, societies have access to energy. And so I actually think that that it has been a mistake to make the Western countries' oil and gas majors the public enemy. Because, and from a Nordic or a Scandinavian perspective, we are, of course, being very close to Russia. I'd rather have my energy come from Total or the Norwegian oil majors than from Gazprom.
Yeah.
And of course, this is a challenge. So I think that my priority would be to tackle the energy and the related SDG on that.
Energy is exactly the short term versus long term, right? Short term, there is a crisis. I mean, customers are suffering, like, do you reduce prices? Like, even though it might be the opposite of what you mean by climate transition, right?
Yeah.
Interesting. So Megan, so your last comment on the same issue, right? So you said, like, obviously within a business, any initiative ticks many boxes on SDG. But are there instances where if you make progress on one, it comes in conflict in another, and where the trade-offs are going to be there? Can you talk about that particular issue?
Yeah, I find less a conflict between SDGs, more a conflict between an existing business model or system and your desire to focus on a particular SDG. And I think we certainly, I sort of feel like an integrate and amplify approach is very important. So really understanding where your power is. It should be part and part power, metaphorically, not not in terms of oil and gas necessarily, but really thinking about where, what the strength of your organization is and what you can affect, what you can be catalytic at. Certainly that's one of the selectors for me about which SDGs, right? Because that's your best hope for making significant impact, right? Is where you can take something that you already have and push it in a particular direction. Or likewise, where you decide you're going to stand behind one particular, SDG in a very strong way as part of your mission. That's another strategy. And then there are SDGs that I think are just common sense, like, gender equality. I think gender, and I think we're done having this gender conversation. I think if you're not, gender balanced on your board and in your senior leadership, and if you don't have equal pay and you don't have, the right way to look at your workforce and encourage opportunity and aspirations for all the different groups who work with you, I think you're not doing good business. So that one just seems to me to be really a basic one from a corporate standpoint. From a global standpoint, we have a lot of work to do to invest in leveling the playing field for women and girls. And that starts with education, which is, of course, one of the SDGs. So some of the SDGs align extremely quickly to each other. And if we look at those in the old Project Drawdown, or even, Johan Rockström's Planetary Boundaries framework, you start to be able to group the SDGs pretty quickly into, say, 5 or 6 buckets. And then you can take that strategy to say, okay, this bucket I'm going to focus on. So I don't see so much that trade-off, maybe between things like decent work and supply chains, and then climate, that can be a little bit sometimes at odds with each other. I think that I would agree with Ulrika. I think the moment is here for partnership, for energy transition, and climate justice. Really looking at how to invest in making a just transition for people and to protect people so we don't have more Ukraine situations, which is what we're headed for if we're not careful about that. So yeah, I think there's a lot of urgency right now on that.
Excellent. So it's been a great conversation. Thank you so much. Thank you also for, picking up on each other, bouncing off ideas. I really loved the dynamic, right? So I think, it's been great. I hope the audience, also found it interesting. And thank you so much for your time today.
Thank you, everyone. Really enjoyed that.
Thank you very much.
Thank you very much.
Namaste.
Thank you.
Thank you, Ulrika. Thanks, Megan. Thank you, Andrea. It was a pleasure hosting you all. Thank you, Shiva, for conducting the panel so patiently and thought-provokingly. It was really interesting.
Thank you.
All right. So we will be in touch with you shortly. And since this is the end of day 1, I would request my colleague, Mr. Gautam, to do the wrap-up for today. And thank you so much to the audiences who are still with us. You have been patiently listening. That's been really, really very encouraging. Thank you.
Thank you, Gayatri. I think it was very informative today. Lot of new things, even for me. I have noted down personally a lot of new things for me. It's a learning experience. I hope everybody must have felt the same. And we meet at the same time, 5:30 in the evening for India, 17:30 hours Indian Standard Time. And we have more exciting, in fact, very novel topics to be handled tomorrow. More on sustainable food systems and regeneration, moving from sustainability to regeneration. These are very evolving topics, and I hope you would learn a lot. Please do join us tomorrow at the same time, and don't forget to live stream our YouTube links to your colleagues and friends. And we'll also be, a lot of people have been requesting for the link for the recordings, which we'll do in the early next week. We'll probably be sending the link for the recording to everyone. Don't worry about that. And probably you'll also be able to, once you attend the 5 sessions, you'll also be able to download your certificate and also claim your BOE credits. So thank you and good night. See you tomorrow.
Thank you, everyone. Thanks a lot. Have a great evening. Bye-bye.